All right, let's get right into it. You're thinking about buying an auto body shop. It seems simple enough, right? Fix cars, get paid. But the real story, the real value is hiding under the hood, so to speak. We're going to walk you through an expert's guide, step by step, so you know exactly what a shop is worth.
And really, that's the million-dollar question, isn't it? When you're looking at a shop for sale, how do you know if it's a hidden gold mine or just a money pit waiting to happen? Well, by the time we're done here, you are going to have the exact blueprint to tell the difference.
Okay, first things first. Before you even glance at the books, the tax returns, or the shiny equipment, there is one single thing that can absolutely make or break the whole deal. Get this wrong, and nothing else matters.
And what is it? It's all about the insurance contracts. You see, in the modern auto repair world, the real lifeblood of a successful shop isn't just random people walking in off the street. Nope. It's that guaranteed, steady flow of work that comes from having solid, direct relationships with insurance companies.
And I am not exaggerating here. The expert business broker we're drawing from for this explainer, he calls these relationships absolutely stinking critical. Think about that. Without them, a shop is basically just a garage with a bunch of tools. With them, it's a real sustainable business. So, you can think of these contracts as the goose that lays the golden eggs. But, and this is a huge but, here's the catch. Are they actually transferable? See, a lot of the time, these deals are tied personally to the owner, not the business name on the sign. Why? Because the insurance companies trust it's with that person, their reputation, their certifications. So you have to confirm, beyond a shadow of a doubt, that you can inherit these contracts. It might even mean asking the seller to stick around for a bit to make sure that handover is seamless.
Okay, so let's say you've done your homework. The insurance situation looks solid. Now it's time to give the business a proper health check. We're going to look at 3 key numbers. Think of these as the shop's vital signs.
First up, annual sales. The magic number here is $500,000. If a shop is making less than that, it's generally only considered to be worth the value of its assets. The equipment, the tools, which usually comes out to around $125,000. There's no extra value, what they call goodwill, for the business itself. It's just a collection of stuff at that point.
Next, let's talk about overhead, specifically rent. There's a classic rule of thumb in this business. Your rent should never be more than 10% of your total sales. If it is, that's a huge red flag. It means those high fixed costs are probably just eating up all your potential profit.
All right, let's move on to efficiency. I want you to picture each service bay in the shop as its own little mini business. A really productive, successful shop should be cranking out about $150,000 in revenue per bay every single year. This is just a fantastic way to measure how well the business is actually using its physical space.
So, we've taken the shop's pulse, checked its vital signs. Now, let's pull back and look at the bigger picture, the financial blueprint for the entire industry. This is so important because it gives you a baseline, a yardstick to measure your target shop against the average.
Just look at this breakdown of where all the money goes. It's pretty clear, right? Wages and parts, they eat up the lion's share of the costs. And then, after every single bill is paid, that little slice of the pie that's left over, that's the profit. And the industry average is a razor-thin 6.1%. It really shows you that every single dollar counts in this business. And if we dig a little deeper into that efficiency piece, check this out. The average employee generates about $112,000 in revenue. That is a key driver of that tiny profit margin we just talked about, especially when you see that the average wage is sitting around $34,000. So here's a quick look at the US market as a whole. And the thing that really jumps out is how small the average shop is, just 2.6 employees. This really hammers home a fantastic piece of advice from our source. You always need more people in the back, in the bays, actually making money than you have people in the front office.
Okay, we've got the vital signs, we've got the industry benchmarks. Now, for the main event. How do we take all this information and turn it into an actual price tag?
Well, here are the standard rules of thumb that everyone in the industry uses. Basically, a shop's value is a multiple of what it earns. The go-to metric for a small business like this is something called SDE, or Seller's Discretionary Earnings. The easiest way to think about SDE is, it's the total amount of cash the business generates for the owner. So you take the net profit and you add back in the owner's salary and maybe some other perks they run through the business.
Okay, but which multiple should you use? Is it worth 1.5 times earnings, or is it closer to 2.3? The answer is pretty straightforward, and it all comes down to performance. The stronger a shop's cash flow, the healthier its vital signs, the higher the multiple it's going to get. It's that simple.
A better business commands a better price.
But look, the numbers on the profit and loss statement, they don't always tell the whole story. If you want to be a savvy buyer, you've got to learn how to read between the lines and investigate the stuff that's a little less obvious.
And that brings us to the elephant in the room for any small service business, cash. You know what I'm talking about. Those small ding and dent repairs, especially on older cars where the owner doesn't want to involve insurance, a lot of that happens with cash.
So, as a buyer, how do you deal with that? The rule is simple and you need to stick to it. You can't put a value on what you can't prove, period. If a seller is telling you about all this cash business they do, you need to find a way to verify it. A good way is to check their cost of goods. I mean, did they actually buy enough paint, enough parts to do all that extra work? You can cross-reference that with the jobs you can prove from the insurance paperwork.
It's also really important to understand where the work is coming from. Take a look at this. About half of a typical shop's business is major collision repair. And this brings us right back to where we started. It's the exact reason why those insurance contracts are the absolute foundation of a healthy shop.
And what about the competition? Well, here's the thing. You're probably not going to be up against some massive national chain. This market is dominated by independent mom-and-pop style operators. In fact, almost 80% of all shops are independents.
And here's a number that helps put all that revenue talk into perspective. The real bread and butter for a body shop is that job ticket between $1,500 and $2,500. That sweet spot accounts for more than 60% of all the jobs they do.
Okay, let's bring it all home. Here is your final checklist. Step 1, and you can't forget this, verify those insurance contracts. Are they solid? And most importantly, are they transferable? Step 2, check the vital signs, sales, rent, and revenue per bay. Step 3, run the numbers. Use those industry formulas to get a realistic price range. And finally, Step 4, play detective. Dig into the hidden details, like the real cash flow and where the work is actually coming from.
So there you have it. That's the complete blueprint for figuring out what an auto body shop is really worth. You've got all the key metrics, all the make or break factors right in front of you. Now the only question left is, are you ready to go find that deal?